Okay, so the Indian banking, financial services, and insurance sector, BFSI, it feels like it's not just changing, it's practically, reinventing itself every few months.
Yeah, it really does.
And this isn't some abstract economic concept. It touches all of us, right? How we save, spend, borrow, plan for the future. It's a really dynamic space.
Absolutely. And when you look at the numbers, the sheer scale of this evolution becomes crystal clear. Back in 2005, the entire Indian BFSI sector had a market cap about, what, INR 1.8 trillion.
Right.
Now, fast forward to today, 2025, and that figure has exploded to around INR 91 trillion.
Wow.
That's a 50-fold increase in just 2 decades.
50 times. That's not just growth. That's a fundamental transformation. For this deep dive, we've got a fascinating thematic report that's dug deep into this journey. Our goal is to go beyond just the headlines and really understand the core trends, those unexpected shifts, and the crucial insights that will give you a much clearer picture of what's been happening and, perhaps more importantly, why.
Exactly, and the report highlights several interconnected forces driving this change. We're seeing a massive acceleration in digitalization, significant regulatory reforms shaping the industry.
Right.
The powerful impact of fintech companies both as disruptors and collaborators, and fundamental shifts in India's demographics.
And while the traditional banks are still major players, it feels like their long-held dominance might be facing some new challengers. Bit of a shakeup.
That's a key part of the story, yeah. In 2005, banks represented roughly 85% of the total BFSI market cap.
85%.
Yeah. Today, that share's come down to about 57%. That tells you a lot about the increasing prominence of non-banking financial companies, NBFCs, and of course, the agile and rapidly growing fintech sector.
That gap is basically NBFCs and fintech stepping in.
Pretty much. And what's truly game-changing, I think, is how fintech is forcing traditional banks to kind of unbundle their services and compete on individual product lines, something we haven't really seen at this scale before.
Yeah, that's a great point. Here's where it gets really interesting, too. This report also underscores how the BFSI landscape itself has become so much broader and more intricate. Apparently, one firm, MOFSL, now covers more than double the number of BFSI stocks it did just a few years ago.
Yeah.
Like from 30 in FY20 to around 70 currently.
Wow, that's a jump.
And back in FY10, it was only 25. That jump really illustrates how many new players and business models have emerged. It's not simply about tracking loan growth and asset quality anymore, right?
Exactly. The focus has expanded. It's now also about cost efficiencies, how companies are differentiating themselves in a crowded market, and crucially, their ability to adapt and stay ahead of all these industry disruptions.
So this deep dive is all about understanding that bigger picture, the why behind these changes.
Precisely.
Okay, let's delve a bit more into that market capitalization surge then, that over 50x jump. What kind of annual growth rate are we looking at over those 2 decades?
Well, that translates to a compound annual growth rate of approximately 22%.
22%? CAGR. That's huge.
It's a really significant and sustained period of expansion. And as we've touched on, the makeup of that market cap has fundamentally changed. The traditional strength of banks has softened somewhat,
Making way for the others.
making way for the increasing influence of NBFCs and, most dramatically, fintech companies.
And that fintech space, it sounds like it's gone from practically nothing to a major force in a relatively short time.
Absolutely. I mean, until around 2015, the fintech sector in India had a negligible market cap, almost non-existent in these terms.
Right.
Now it boasts a combined valuation, including both listed and unlisted entities, of over INR 12 trillion.
12 trillion.
Just like that.
Yeah. It's a powerful illustration of the speed and magnitude of the disruption we've witnessed. It does make you wonder, though, if this kind of explosive growth is sustainable in the long run, or if we'll see some, consolidation or recalibration down the line.
That's a great question. Is it a bubble or just rapid maturation? And it's not just about the absolute size, is it? The report also highlights how the BFSI market cap compares to the overall economy. Yes, that's another key metric. The BFSI market cap as a percentage of India's GDP has seen a really substantial increase. In 2005, it represented about 6% of the total GDP.
6%. Okay.
And by 2025, that figure has grown to around 27%.
27%. So almost a quarter of the economy's value represented by this sector.
Yeah, it really underscores the growing importance and influence of the financial sector within the broader economic landscape.
Now, a big sector isn't necessarily a healthy sector. What's the report telling us about earnings growth and the overall financial strength, the net worth of these institutions.
Okay, good point. The report indicates a pretty robust recovery in earnings for the BFSI sector, particularly after the hit from COVID-19.
Right.
Interestingly, over the last 10 years, the earnings growth of the banking sector has actually outpaced the earnings growth of the broader market.
Okay, so banks are pulling more than their weight in terms of profit growth compared to the overall market.
Precisely. The contribution of the BFSI sector to the total earnings of the Nifty 50 index has almost doubled. In FY10, it was around 16%.
16. Okay.
And by FY24, it had climbed to a significant 33%.
Wow. One-third of Nifty earnings coming from BFSI. That's substantial.
It really is.
And looking at the different kinds of banks, it seems the private sector banks are really leading the way in terms of earnings expansion. Is that right?
Yes, the private banks have demonstrated remarkable earnings growth. From the lows of FY20, their combined earnings are projected to have increased roughly tenfold.
Get done times.
Yeah, reaching about INR 1.84 trillion in FY25 estimate. But it's not just the private players. The public sector banks, or PSBs, have also shown a really significant turnaround.
That's interesting, considering their past issues.
Definitely. Their aggregate earnings are expected to hit INR 1.7 trillion in FY25. This kind of recovery in PSB earnings is quite notable, especially given the challenges they faced with asset quality not too long ago.
Definitely a significant shift for the PSBs then. And underpinning this profitability must be a solid financial foundation. What about their net worth?
Absolutely crucial. The report highlights a steady growth in the net worth of the banking sector at a healthy EGR of 16% over the past 2 decades, reaching INR 26 trillion in FY24.
16% CEGR on net worth. Solid.
And NBFCs have also experienced similar growth in their net worth, reaching INR 12.4 trillion in FY24. This strong capital base is, it's crucial. It provides a buffer against potential economic shocks and reinforces investor confidence in the sector's stability.
So bigger, more profitable, and seemingly more stable.
Okay.
Another key trend the report talks about is the retailization of loan books. For someone listening who might not be familiar with that term, what does it really mean for the average person?
That's a good clarifying question. So when we talk about the retailization of loan books, we basically mean a significant shift towards banks and other financial institutions lending more to individual consumers.
Like home loans, car loans, personal loans,
Yeah.
that kind of stuff.
Exactly, stuff like that, as opposed to primarily lending to big businesses. While overall bank credit to GDP has remained fairly stable at around 55% over the last decade. Okay.
The proportion of that credit going to individuals has increased substantially. The share of retail credit in GDP is nearly doubled, from 9% in FY14 to an estimated 18% in FY25.
Doubled. And what's behind this increased focus on lending to individuals? Why the shift?
It's really a confluence of factors. Private banks have been actively expanding their retail loan portfolios, seeing opportunity there.
Right.
The increasing use of digital technologies and the rise of fintech platforms have streamlined the whole process of accessing credit for individuals. It's just easier now.
Makes sense. Less friction.
And importantly, regulatory efforts aimed at promoting financial inclusion have played a significant role in bringing more people into the formal credit system.
So even with this growth in retail lending, does India still have a lot of untapped potential compared to other countries? Are we lagging behind?
Absolutely. The report emphasizes that India's retail credit penetration, basically, the amount of retail credit compared to the size of the economy, is still lower than in many other parts of the world.
This suggests that there's considerable room for further growth in retail lending, especially given India's expanding middle class and, rising aspirations. We've seen the systemic retail loan mix increase from 18% in FY14 to 34% in February 2025.
Still climbing.
But there's still a way to go to reach levels seen in more developed economies.
Interesting, still a significant runway for retail credit growth. The report also highlights the untapped potential within the retail segment in terms of who is being served. Can you elaborate on that? It's not just about volume, right?
Right, it's about reach. If we connect this to the bigger picture of financial inclusion, India has this vast pool of adults who are potentially credit eligible. The report estimates around 814 million people.
Okay, 814 million, wow.
But here's the thing. A significant portion of them, about 58%, are classified as credit unserved, meaning they just don't have access to formal credit at all.
Over half.
Yeah. And another 20% are underserved, maybe holding only one credit product, like a basic credit card or something. That leaves just about 22% who are considered fully credit served.
So only about 1 in 5 eligible adults are fully participating in the credit market.
Exactly. It really makes you think about the opportunities that exist to bring more people into the formal financial system. and the challenges, too.
That's a stark contrast with more developed economies, I imagine.
It is. In countries like the US and the UK, the percentage of credit underserved individuals is much lower, typically in the range of just 3% to 7%.
3 to 7% versus nearly 80% unserved or underserved here. That's a huge gap.
It really highlights the enormous opportunity in India to expand access to credit. But the positive trend is that the number of credit-served consumers in India has almost doubled in just 5 years, from 91 million in 2017 to 179 million in 2022. So progress is definitely being made.
Okay, so while there's a long way to go, the momentum seems to be in the right direction. Good to hear. Now, shifting to another fundamental aspect of BFSI deposits, you need deposits to lend, right? What's the story with deposit accounts in India?
Right, deposits are the bedrock. And this raises an important question about how deeply banking services are actually penetrating the population. The numbers are impressive on the surface.
Okay.
Over the last decade, the number of deposit accounts in India has more than doubled, reaching an impressive 2,652 million.
2.6 billion accounts.
Yeah, and even more striking is the per capita growth. The number of deposit accounts per person has tripled in the last 15 years, from 0.63 in FY10 to 1.90 in FY24.
Nearly 2 accounts per person on average. That sounds like a massive step towards greater financial inclusion.
It certainly indicates a wider reach for banking services. However, the report does rightly point out that the quality of these accounts, in terms of activity and the size of balances, that's a crucial factor to consider.
So just having an account doesn't mean much if it's empty or dormant.
Exactly. Simply having an account doesn't guarantee active usage or significant savings. The report also notes that there are still considerable untapped markets, particularly in central states like Uttar Pradesh, Bihar, Madhya Pradesh, and Jharkhand.
Areas that have historically had lower levels of banking penetration.
Precisely. Banks that can effectively reach and serve these populations have a significant growth opportunity ahead of them.
And a major catalyst for this growth in account numbers has been the Jan Dhan Yojana, the government's big financial inclusion program.
Oh, absolutely. Jan Dhan has been huge. The number of accounts opened under this scheme has grown dramatically, from 145 million back in 2015 to 520 million in FY24.
Over 500 million accounts just from that scheme.
Yeah, it's clearly been a game changer in expanding access to basic banking.
Okay. Now let's talk about something that has fundamentally altered the financial landscape, digital payments. And we have to talk about UPI.
UPI. Yeah, what's fascinating here is just the sheer speed and scale at which UPI has been adopted. It has truly revolutionized how people transact in India. It's hard to overstate its impact.
It feels like it happened overnight almost.
It does. As of February 2025, UPI accounts for a remarkable 93% of the total volume of digital transactions.
93%. Up from what?
Compared to just 68% in FY21. So that dominance has really solidified quickly.
That's incredible. What's driven this explosive growth?
Well, it's been kind of a perfect storm of factors, really. Rapid advancements in mobile payment technology, a strong push from the government for digital transactions.
Demonetization probably helped there initially.
That certainly gave it a nudge. Plus, increasingly affordable mobile data and the widespread adoption of smartphones across the country. The result? The total volume of digital transactions has surged tenfold, from about 20.7 billion in FY18 to an estimated 200 billion in FY25.
200 billion transactions.
And maybe even more staggering, the value of UPI transactions as a percentage of GDP. It's skyrocketed from just 1% in FY18 to a massive 71% in FY25.
71% of GDP flowing through UPI. That's almost unbelievable.
It's a huge number. It really makes you wonder if we'll see this level of dominance continue or if, new payment methods will emerge to maybe challenge UPI's reign eventually.
Yeah, will something disrupt the disruptor? But the report does mention a challenge around sustainable monetization due to the low merchant discount rates, the MDR. What are the implications of that? How do these guys make money?
Yeah, that's the big question. While UPI's adoption is phenomenal, the fact that there's typically zero MDR on peer-to-peer transactions and very low rates on merchant transactions creates a challenge for the payment service providers in terms of generating consistent revenue.
So they're facilitating trillions in transactions, but struggling to directly profit from it.
In many cases, yes. However, the expectation is that as the ecosystem matures and new use cases for UPI develop, things like credit on UPI, UPI Lite for small offline payments, the integration of RuPay credit cards, more monetization opportunities will eventually expand. But it's still an evolving picture.
Okay, so UPI is a transformative force, but the business model is still kind of working itself out.
Got it. Now, let's shift our attention to the role of fintech companies more broadly. Are they primarily disrupting the traditional players, or are they also playing a significant role as enablers within the BFSI sector?
The report suggests they are very much both. Fintechs have certainly disrupted traditional areas of the DFSI sector by offering innovative and often more user-friendly financial solutions. We've seen them gain significant market share, particularly in areas like payments, lending, and investment platforms.
We're talking about companies like PhonePe, Google Pay, Grow, Paytm, names that have become household names, basically.
Exactly. These players have captured substantial market share and are really at the forefront of driving growth and innovation in the financial industry. But it's not solely about disruption.
Fintechs are also increasingly acting as enablers by forming partnerships with traditional banks and NBFCs. These collaborations are leading to the development of more efficient, technology-driven solutions and, ideally, an enhanced customer experience. It's becoming quite a symbiotic relationship in many instances.
So a collaborative as well as a competitive dynamic. Frenemies, maybe?
Something like that. Precisely. Fintech companies have attracted significant capital investment, naturally. And the report highlights that these newer companies accounted for about 10% of the incremental market capitalization of the entire BFSI sector between FY20 and FY25.
10% of the new value created.
Exactly. And interestingly, the combined market valuation of unlisted BFSI companies, the ones not yet on the stock exchange, is estimated to be around INR 10 trillion.
10 trillion in the unlisted space.
Yeah, indicating the significant value creation happening outside of the public markets as well. Lots of venture capital flowing in.
And just to get a clearer picture of those major UPI players you mentioned, the report provides some data on their market share, right? How dominant are they?
Yes, it does. As of January 2025, PhonePe held the largest share in UPI transaction value, around 52%.
Over half.
And also in volume, at about 49%. Google Pay was the next largest, with approximately 36% of the value and 37% of the volume.
So between those two, you're talking about what, almost 90% of the value and volume?
Pretty much. These figures really illustrate the dominance of these two players within the UPI ecosystem. It does raise that question again, though, about whether this concentration of power could potentially stifle competition or innovation in the long run, something regulators are likely watching.
Yeah, that's a really important point to consider, a duopoly almost. Now, with the rise of online and mobile banking, what's happening with the traditional physical bank branch? Are they becoming obsolete? Are we seeing them disappear?
Well, the report points to a noticeable slowdown in the expansion of physical bank branches overall, which makes sense, right? With a growing number of people using online and mobile banking platforms, the need for extensive branch networks has decreased, and banks are increasingly prioritizing investments in their digital infrastructure. Building and running branches is expensive.
That seems logical. Why maintain a large physical footprint if customers are primarily engaging online?
However, and this is important, the report also highlights that despite the surge in digital transactions, cash usage still remains significant in India.
Still a lot of cash floating around.
Absolutely. And that underscores the continued relevance of branches for certain banking functions, particularly things like deposit mobilization and serving customers who are not yet fully comfortable or able, perhaps, to use digital channels.
So not dead yet.
Not dead yet. Many banks are adopting what they call a phygital strategy, merging physical and digital.
Digital. Okay.
Yeah, aiming to integrate their digital and physical services to provide a seamless customer experience. This is particularly crucial in semi-urban and rural areas where a physical presence can still build trust and attract customers who may be less digitally savvy.
Right. Trust is a big factor there.
Definitely. And interestingly, the report notes a divergence in branch expansion strategies. Some private banks, like HDFC Bank, for example, are still aggressively expanding their branch networks. They added over 3,800 branches between FY21 and FY25.
Still building new branches.
Yeah.
Wow.
In contrast, public sector banks seem to be focusing more on consolidating their existing branches, closing some down, merging others, and placing a greater emphasis on digital banking and business correspondence.
So private banks still see value in physical expansion, maybe for capturing those deposits, while PSBs are leaning more towards digital optimization and rationalization. Interesting contrast.
Exactly.
Another interesting aspect highlighted in the report is the idea of leaner workforces. How has the growth in the banking sector's balance sheets compared to the increase in its employee count?
This really underscores the efficiency gains that have been achieved largely through technology. Over the past 2 decades, while the total balance sheet size of the banking sector has grown by more than tenfold,
10 times bigger.
the number of employees has increased by only around threefold.
Okay, so assets grew way faster than headcount.
Exactly. This significant difference points to improved operational efficiencies, the increasing adoption of automation for routine tasks, and the impact of digitalization in optimizing workforce requirements, doing more with relatively fewer people.
That's a clear indicator of how technology is enabling banks to scale their operations without a proportional increase in manpower. Makes sense.
Yeah.
Now let's discuss something critical for the stability of the financial system: asset quality. Bad loans were a huge problem a few years back. What's the trend been with non-performing assets, or NPAs?
Yeah, that was a major overhang, but the report offers quite encouraging data on this front now. Asset quality ratios have shown a steady and significant improvement.
Good news then.
Definitely. The gross non-performing asset GNPA ratio is projected to decline to 2.5% in FY25,
2.5%. Down from what?
down from its peak of 11.2% back in FY18.
Wow, that's a massive drop.
Huge improvement. Similarly, the net non-performing asset NNPA ratio, that's after provisions, is estimated to fall to just 0.6% in FY25, down from a peak of 6% in FY18.
0.6% net NPA. That's very low.
It is. This improvement is a really positive sign for the overall health and resilience of the banking sector.
That's a substantial improvement across the board. What factors have contributed to this positive trend? Why are things better?
Well, it's several factors playing a role. Banks seem to have adopted more stringent underwriting practices in recent years, being more careful about who they lend to.
Learning from past mistakes.
Hopefully. There have also been enhanced recovery efforts by banks using tools like the Insolvency and Bankruptcy Code, or IBC. And of course, a more supportive economic environment in recent years has helped borrowers stay current.
Okay.
The report even highlights a striking comparison. The average slippages, that's the rate at which good loans turn bad for just the State Bank of India in FY 18-19, were actually higher than the aggregate slippages of all public sector banks combined in recent years.
Just SBI's bad loans, then, were worse than all PSBs put together now.
In terms of new slippages, yes. It really illustrates the significant progress made in improving asset quality, specifically within that PSB segment, which was the epicenter of the problem earlier.
That's a really striking statistic. Highlights the turnaround. Okay, now let's move on to another area that's seen explosive growth: the mutual fund industry in India. It's been quite a success story, hasn't it? Feels like everyone's talking about SIPs now.
Absolutely. The Indian mutual fund industry has experienced tremendous growth. Its assets under management, or AUM, have just soared from about INR 1.2 trillion back in FY04
Okay, starting small.
to a remarkable INR 67.6 trillion as of February 2025.
67 trillion. That's phenomenal growth.
It is. That's a compound annual growth rate of over 20% over the past decade, which is quite extraordinary by any measure.
What are the key factors driving this phenomenal expansion? Why are people suddenly investing so much more in mutual funds?
Well, it's a combination of factors. Again, increasing digital adoption is a big one. It's just so much easier now for people to invest through apps and online platforms.
Lowering the barrier to entry.
Exactly. Supportive regulations from the market regulator, SEBI, have also helped build trust and structure. And crucially, there's been a significant rise in retail participation as financial literacy improves, and more individuals seek avenues for wealth creation beyond traditional options like fixed deposits or gold.
People looking for better returns.
Pretty much. The report also emphasizes the increasing contribution of equity mutual funds, which now account for 55% of the total AUM. People are embracing equities more.
More risk, potentially more reward.
Right. And you mentioned SIPs. The growth in monthly systematic investment plans has been remarkable. It's jumped from about INR 31 billion a month in April 2016 to INR 260 billion a month in February 2025.
260 billion a month going to SIPs.
Yeah, the popularity of SIPs has really democratized mutual fund investing, making it accessible through small, regular contributions.
SIPs have truly made mutual funds more accessible to the average investor. It feels less intimidating than lump sum investing.
They have indeed. And this is reflected in the numbers. The significant increase in retail mutual fund folios, or accounts, which have grown to 232 million in FY25 year to date, from just 83 million in FY19.
A huge jump in accounts.
And maybe more importantly, the number of unique investors has risen from less than 10 million in FY10 to around 50 million currently.
50 million Indians investing in mutual funds now.
Around that mark, yes. This indicates a growing awareness and confidence in mutual funds as a viable long-term investment option.
That's a testament to the growing financial awareness among the population. Great stuff. Now, let's turn our attention to another vital part of the BFSI sector, the insurance industry. How has it been adapting to the changing landscape? It also feels like it's growing fast.
It is. The Indian insurance industry has undergone a significant transformation itself. It's evolved from being largely dominated by public sector players, LIC and the general insurers,
Right.
to a much more competitive market, with over 60 insurers operating across life, general, and health insurance today.
60 players now. Lot more choice.
Definitely. And both the life and general insurance segments have experienced rapid growth. This has been fueled by factors like rising income levels, supportive regulatory frameworks from IRDAI, the expansion of distribution channels, including digital platforms and bank assurance.
Selling insurance through banks.
Exactly. And also increasing consumer awareness of the need for insurance coverage, partly driven by experiences during the pandemic, perhaps.
Can you give us a sense of the scale of this growth in premiums? How much bigger is the market?
Sure. In the life insurance sector, new business premiums, the money from new policies sold, have grown from over INR 700 billion in FY07 to around INR 3.8 trillion in FY24.
3.8 trillion new life premiums.
And renewals, the premiums from existing policies, have also seen substantial growth from about INR 800 billion to over INR 4.5 trillion during that same period. So the overall pie is much larger.
And the general insurance side.
Yeah.
Health, motor, etc.
That side has witnessed about a tenfold increase in gross direct premium income, or GDPI, between FY07 and FY24. This is driven significantly by the growth in health insurance, rising automobile sales requiring motor insurance, and general industrial and economic expansion needing various covers.
10 times growth in general insurance. Those are impressive growth figures across the board.
Yeah.
But is there still significant potential for further expansion in the insurance sector in India? Are we underinsured?
Absolutely. The short answer is yes, very much so. The report highlights that both life insurance penetration, which is premiums as a percentage of GDP, stood at 2.8% in FY24.
2.8%.
And non-life insurance penetration, at just 1% in FY24.
Only 1%.
Remain considerably underpenetrated in India compared to global averages, which are much higher.
So huge room to grow still.
Exactly. This suggests a substantial untapped market opportunity as financial literacy improves further, incomes rise, and digital channels continue to make insurance products more accessible and perhaps more tailored to a wider population.
So, similar to retail credit, a large untapped market in insurance as well.
Mm-hmm.
Okay. Now, let's touch upon a segment that has shown resilience and growth. Sometimes under the radar, small finance banks, or SFBs. What's their story?
That's right. SFBs have demonstrated a pretty strong growth trajectory, even while navigating some challenges in the microfinance MFI segment, which is where many of them originated.
They started mostly as MFIs, right?
Many did, yes. A key factor in their success has been their ability to attract deposits, often by offering slightly higher interest rates compared to the larger traditional banks. That helps them build their funding base.
A way to compete for funds.
Exactly. And on the lending side, they've shown much faster credit growth. The report mentions a 24% CAGR between FY20 and FY23, compared to the broader banking sector's 10% over that period.
Growing more than twice as fast.
Yeah, but that faster growth, of course, also warrants careful monitoring of their asset quality, especially given their focus often on lower income segments or small businesses.
Right. Higher growth can sometimes mean higher risk. Are they diversifying their loan books?
They are. They seem to be finding a specific and growing customer base, but they're also strategically shifting their focus towards more secured lending products. Things like small home loans, vehicle loans, loans against gold, and MSME loans backed by collateral.
Moving away from unsecured MFI loans.
Gradually, yes, which helps in mitigating credit risk. SFBs have also been aggressively expanding their branch networks, particularly in semi-urban and rural areas, with a 29% CAGR since March 2018, primarily in South India, according to the report.
29% branch growth. They believe in phygital too, then.
Seems so. And looking ahead, the Reserve Bank of India, RBI, has issued guidelines allowing eligible SFBs to potentially transition into universal banks.
Become full-fledged banks like the big guys.
Exactly. And some SFBs have already applied for this license. If approved, this could further reshape the banking landscape, introducing new competitors at the universal bank level.
Interesting. So SFBs are not only growing, but also have aspirations for broader banking roles. Now, as we sort of synthesize all of this, the report emphasizes the accelerating pace of transformation in the BFSI sector. It feels faster now than ever. What are the primary drivers behind this rapid change?
Yeah, the speed of transformation is indeed remarkable, maybe unprecedented. It's driven by a powerful combination of factors. Technology is clearly at the forefront.
AI, blockchain.
Things like artificial intelligence, machine learning for credit scoring, or fraud detection, blockchain for certain processes, these are playing an increasingly pivotal role. The rapid expansion of digital payments, as we've seen with UPI, is another major catalyst.
Changing how money moves.
Fundamentally.
Yeah.
And alongside this, you have the evolving preferences and expectations of consumers. People are increasingly demanding digital-first, seamless, and personalized financial experiences. They compare their banking app to their favorite e-commerce app now.
Right, expectations are set by the best digital experiences elsewhere.
Exactly. It's clearly no longer just about the traditional suite of banking products, savings accounts, loans, deposits.
So how are banks and other players adapting their business models?
Well, the revenue streams for financial institutions are also diversifying. While interest income from lending remains important, we're seeing a growing contribution from fee-based services, things like transaction fees, advisory fees, wealth management offerings,
Cross-selling too.
and cross-selling of various financial products like insurance or mutual funds. To thrive in this dynamic environment, financial institutions really need to prioritize continuous innovation, maintain operational agility, the ability to change direction quickly, and adopt a really strong customer-centric approach.
Customer is king, now more than ever.
Pretty much. The report also briefly mentions potential future developments that could accelerate change even further. Things like hyper-personalized banking, where AI tailors services and offers to your individual behavior and needs in real time.
Banking that knows you better than you know yourself.
Potentially. And the potential introduction and impact of central bank digital currencies or CBDCs, which could fundamentally alter the payments landscape again.
Lots more change potentially on the horizon. The future of BFSI certainly sounds incredibly dynamic and heavily influenced by technology. Finally, the report touches on the performance of different segments within the BFSI sector and provides some investment perspectives. What's the overall outlook, and are there any specific areas they favor? Is everything doing well?
Not uniformly, no. The report observes that the performance within the BFSI sector has been quite varied over the past year or so, while the overall Nifty Financial Services Index has outperformed the broader Nifty 50 index.
So financials did better than the market overall.
Yes, but within that, there's been significant divergence in returns among different types of banks and NBFCs. For instance, private banks generally outperformed public sector banks during the period the report looked at.
Okay, so not all boats lifted equally by the tide. Are there any particular segments or specific types of companies that the report highlights as potentially promising for investors based on their analysis?
The report does suggest a preference for private sector banks over public sector banks, generally speaking. They cite reasonable valuations and a healthy growth outlook for the private players as key reasons.
Okay, favoring private banks. What about NBFCs?
Within the NBFC space, they identify vehicle finance as a segment with potentially good prospects, maybe linked to economic recovery and mobility trends.
Makes sense. Insurance, AMCs.
In the insurance sector, they favor HDFC Life and ICICI Lombard specifically. And in the capital markets segment, asset management, brokers, etc., they mention names like HDFC AMC, Nuvama, Angel One, and CAM as potentially interesting.
Specific names mentioned there.
Yeah, but it's crucial to remember, as always, that these are based on the report's analysis at a specific point in time. Investment decisions need a much deeper dive in consideration of individual circumstances. The report emphasizes a selective and well-informed approach is definitely needed.
Right. It's not a blanket buy recommendation for the whole sector. It's about picking the right spots. So a nuanced picture where specific segments and perhaps specific companies seem to offer more compelling opportunities than others.
Exactly. Selection is key.
Well, this has been a truly illuminating deep dive into the rapidly evolving Indian BFSI sector. Feels like we covered a lot of ground.
We certainly did.
Let's quickly recap the key insights for everyone listening. We've seen that remarkable, almost mind-boggling 50-fold growth in market capitalization over 2 decades.
Yeah, the scale is huge.
A significant shift in dominance away from just traditional banks towards private players and the burgeoning disruptive fintech industry.
That changing composition is vital.
The retail credit and digital payment revolutions, particularly the pervasive influence of UPI, are undeniable game changers.
Transforming daily life for millions.
Physical bank branches are adapting with digital strategies rather than just disappearing.
Still have a role to play.
The mutual fund and insurance industries have demonstrated impressive growth, but still hold substantial future potential due to underpenetration.
Lots of runway left there.
And the overall pace of transformation is clearly accelerating, fueled by technological innovation and changing consumer expectations.
Faster and faster, it seems. And I think the crucial takeaway, really, is that the BFSI sector is no longer solely about traditional banking as we maybe knew it 10 or 20 years ago. It has become this vibrant, complex, interconnected ecosystem driven by technological advancements and the evolving needs and preferences of customers like you.
So as we wrap up this deep dive, here's a thought for you, the listener, to consider. Given these rapid and profound changes within the Indian financial landscape, how do you anticipate they will continue to shape your own financial life? And how might they shape the broader Indian economy in the years to come?
Yeah, what opportunities and maybe challenges does this ongoing transformation present for you as an individual, or maybe for businesses you interact with or run? It's worth thinking about.
Definitely. And if any of the topics we've explored today have particularly sparked your interest, maybe UPI's future, or the rise of SFBs, or the potential in insurance,
we encourage you to delve further. Perhaps research specific fintech companies, investigate the future trajectory of digital payments, or explore the growth prospects within different segments of the BFSI sector. This is a continuously evolving landscape.
Always more to learn.
And there's always more to discover.
Absolutely. The BFSI landscape will undoubtedly continue to redefine itself in fascinating ways. Thanks for joining us for this deep dive.